Good evening, gentlemen. How are you? Good morning, Darren. Good evening, Fred.
Hiya, guys.
Look, I thought we'd continue on with some of our walkthroughs as we got a bit of positive commentary, for at least from Twitterland, regarding some of these walkthroughs. I think it is a very good way of at least fermenting in people's minds about this particular technique and what we're trying to catch. It's certainly different to, mean reverting strategies that sort of try and work off a sort of a condition of the market that gives a repeatable experience and therefore almost a sort of a more cash flow orientated sequence of returns. But these particular market moves that we're going for relate to significant, impactful events of outliers which can never be predicted, and therefore you can't adopt a cash flow mentality to these, but you certainly can adopt a wealth generation mentality to them. And in our opinion, we believe that the edge is more significant in this style of trading than in these alternative methods. So there's a couple of examples tonight that we'll go through, including Bitcoin, because based on Darren and my last discussion together, where he tempted me to look at the opportunities with Bitcoin, well, I've finally done something about it, and we've got at least 10 years of data. So it demonstrates something that is quite, fundamentally possible based on the design of our strategies, which offer this infinite yield. And this certainly seems to suggest that we can generate significant profits with particular markets in particular circumstances. So let's get straight into it.
Rich,
can you see my screen at the moment with MetaTrader?
No, not yet. But before you delve into the visuals, I think it's probably worth just clarifying that as usual, we keep refining and chopping and changing and looking for better ways of doing things. And just to talk about the fact that during our last podcast, the demonstration was based on EAs that were looking for 20 runs through each instrument so that it was possible to generate up to 20 trades per instrument. And the equity curves we were seeing were based on that. We've done some further research to try and optimize that even further to the point where we looked at various combinations, and people may recall that we were looking for 20 possible EAs out of the universe, and we were using our random 5 million iterations to try and find the best MAR that we could find out within that 5 million iterations. Well, since doing that, we've spent a bit more time looking at the different combinations there and looking to see what would happen if we actually had more iterations and possibly less trades. And so I think we've ended up in a scenario now where we actually are not looking for 20 any longer, we're only looking for 5. But those 5 are generated from 20 million iterations each. So we've upped the number of iterations, which means we're looking longer to find the optimum, and then we've cut back from 20 down to 5. And one of the reasons was that we were seeing a little bit of duplication in the 20, whereas with the 5 we're seeing less of that. And it also means that if we're looking at a universe of 50, 60 or 100 different instruments, trading 5 EAs per instrument rather than 20 makes that more manageable at a retail level.
Yeah, so you could trade it with a smaller account, effectively.
Effectively, yes, and giving us a broader appeal.
If you could imagine, Darren, with 20 solutions applied to each market, there's only a certain amount of juice we can extract from these major trends in each individual market. So when we're applying 20 solutions as opposed to 5 solutions, the 20 solutions is a bit of overkill. You'll find that a greater number of the percentage of those totals, so a percentage of 20, are more highly correlated than if we chose a smaller range of 5, which were more uncorrelated in nature.
Yeah.
So we've gone from the 20, which was more, we picked a number to start with, but now we've been able to do the analysis. We can now confidently reduce this to 5, which therefore not only gives us a better efficiency in terms of what we're catching, because we're relying on a composite of 4 more uncorrelated return streams, but as Fred was mentioning, it's so much more, effective because we can trade much smaller accounts with it. So
yeah, and are we finding validity in this idea that diversification is good up to a certain point, and then there's like a rollover point where adding more is not really adding to the returns?
Yes, look, they talk about the marginal utility of increasing diversification, where you get to a certain point and the benefits of diversification decrease, but that's a theoretical judgment, which is based on, the old Markowitz and all of those different things. So what we've found is that diversification across asset classes, the more the merrier. You can't get too much diversification, provided you're going across asset classes that are fundamentally different in nature. And at the moment, of course, we're trading liquid instruments on the market, but this relates to any particular asset class, whether it's property, whether it's artworks, whether it's sports betting, whether it's whatever, provided they're disparate in nature and offer an uncorrelated relationship to the rest of the portfolio. It's always better adding more and more diversification. But because we're applying a single system here with this Donchian breakout technique to a single market, such as the Euro USD or the Pound USD or commodities or whatever, each individual market has its own inherent trending points or mean reverting points. So there is a limited amount of diversification that can actually be applied within that actual individual market itself. So we can't go too much on the diversification within a market, but we certainly can go very broad across asset classes.
Yeah, and is that being reflected in these kind of first experiments in reducing the size of the portfolio?
Exactly. So
you're finding that
in these demonstrations, we looked at a 20 solution. We've now narrowed it down to a 5 because it was overkill. 20 was overkill, and a large number of them were basically correlated with each other. So
so there'd be a fair number of strategies that essentially are getting the same juice out of the trend, so there's no point doubling up.
Yes, that's right. And at the portfolio level, of course, what that does is when you get correlated return streams, when things are positively correlated and the market is favourable, well, that's absolutely fantastic from a trend following perspective. However, positive correlation when the markets are unfavourable is very negative to our cause. Yes. So, unlike, say, mean reverting techniques, they're looking at they can't really diversify like we're diversifying, because mean reverting techniques are a concentrated strategy based on the principle that there is a known equilibrium point. So you want your strategy to get out or exit your trade at that known equilibrium point. Yeah. But dealing with these trend following strategies where we're dealing with the unknown, we don't know how long these transitions will occur for between these points of sort of equilibrium. They could go for a very long time. So there is no known future point we want to target. And that's why we need to be diversified, because we could get an array of different outcomes. And with diversification, gets better risk-adjusted returns. That's the important thing, the risk-adjusted returns, the relationship between the reward and the risk. And so, a good example there is that often when people talk about the success of a strategy, they're only thinking in terms of its profitability. But That's only 50% of the equation. The other percent of the equation is how many losses were incurred in obtaining that profit. And if we chose a 25 period Donchian breakout technique, we would catch every trend. But there is a cost to that with the amount of whipsaws we get. So that's the risk to reward relationship being expressed. There's two sides of that coin. So the risk adjusted method that we're looking at, which is looking at a MAR ratio, which is the relationship between the compound annual growth rate and the drawdown, is looking at both sides of the coin, the return profile and the risk profile. Because the two things occur in tandem. Risk and reward are always present in any of these speculative methodologies. There's always an associated risk associated with the return.
Yeah. Before we go in visually to look at some crypto markets, it's kind of worthwhile pointing out the reason we're doing that is because the nature of crypto markets in themselves are perhaps viewed differently, but we're saying by design, if a market, whatever market it is, however it's influenced by banks or not, or retail traders, if it displays these outlier moves, then our strategy by design should work on those markets. And so the reason we looked at crypto was to say, well, look, we know that crypto has these massive outlier moves, so by design our approach should work. Is that correct?
Absolutely.
Yeah.
Look, before we get on to the Bitcoin, I just thought I'd familiarise yourselves once again with a very long-term backtest. In the last podcast, we looked at the pound USD in terms of, I think it was a 30-year backtest, at least back to 1983 to current day, just to demonstrate how these strategies were not curve fit, as they were designed over a much shorter time horizon. But in this example, I'll show you a couple of other very long-term backtests. So this will give you a flavour of what to expect and you need to be patient with these particular type of strategies. So the first one I'm going to start on is USD JPY. And I'm going to be looking at a date from 2nd of the 1st, 1982. 2nd of the 1st, 1982. And the spread I'll be using is double the current spread. So I'll be looking at around 24 points in our spread. So we're ready to go. So I'll start this backtest running now. So this is a nice long period, once again, back to 1982. So here we are. I'll put the date indicator here. So we can see we're in 1982 now. This bottom section here, once again, represents our equity curve, the green line representing the floating equity and the blue line representing the realised balance. Now, we focus on this floating equity as the realised balance just relates to current close trades. The floating equity is more important to us as it relates to the unrealised profits at this point in time, including the realised balance. So back in the 1980s, we commenced with some short moves, and now we're into a nice long move. Now, this strategy here is one of these 5 solution series, not the 20 solution series that we demonstrated last podcast. So in this example here, we can see 1, 2, 3, there were 4 solutions struck with this long trade here. Now we have a nice short period. Floating equity is going up nicely. I forgot to mention, we started, because we're dealing with a smaller number of solutions, this is trading off an initial balance of 100,000. Now, of course, Fred and I will be looking at solutions maybe down to a 10,000 balance. But at the moment, it clearly can show how we can operate off a much smaller balance than we were in our last podcast, where I think we had an initial deposit of $1 million in our tests. This is now at 100,000, but quite clearly you can see that we don't get ourselves into trouble using that level of balance. Guys, feel free to comment as we step through.
Yeah, I just like the way that the equity curve kind of maps with what price is actually doing. So where, you know, like there where we saw a big sustained trend, we get that big uplift in returns, you know.
Yes.
I mean, it's doing what we design it to do, you know, to make money off the trends, and periods like this where it's going mainly sideways, then we're not seeing massive drawdowns.
That's right. Something Fred mentioned last week, which really struck me. It's amazing. You live with this many years of your life, and then someone says something that really hammers home a point. And Fred said that what you'll notice is when we're going through non-favourable market regimes, we only have one or maybe two solutions operating. But when we get into these outlier periods, our trade frequency increases with this broader range of options. And you might hear a lot of trend followers saying that they add to winning trades when in a trend. Well, this is achieving that through a greater trade frequency during these outlier periods.
Yeah, it just seems to, you know, this notion of noise as well. It's very good at avoiding. It almost looks like it's predicting the noise, but essentially we're just giving the trades a bit more time to develop and a bit more space when they do.
Yes. This is a beautiful short trade. See, as a discretionary trader, I would never be able to achieve this. This is one thing where a diversified process, a systematic process, will beat you every time. Once again, note the impact here of when we find that our profit starts coming off the table, when the trends start turning, you'll see that our longs are already activated well before the shorts are all finalised. So in this zone here, we're going through a bit of hedging, which ensures that our floating equity never significantly deteriorates before we commence a new trade series. I'll speed things up a bit. I've got a few to get through tonight.
It's also interesting to note there are long periods of you know, your equity not rising, and you know, I
Yes.
think that kind of, when you initially start out trying to explore these ideas, it's those periods that really throw you. You know, especially if you start out initially with some sort of manual approach to this style of trading.
Yes. If you can imagine a trader coming in at this point here with a trend following strategy would experience, maybe that's probably quite a few years of deteriorating equity.
Yeah.
So they would feel, oh, well, this clearly doesn't work. But they're not looking at things at the scale you need to look at trend following. Trend following is something that is a long-term prospect, and those winning periods are monumental, but only over a short duration. There's one here, there's another here. Here's another here where the equity goes flying up. They're periodic. You can't predict when these occur. It's not like a mean reverting system that's looking at a gradual rise in your equity. This nature of trend following is looking for these periodic step-ups, punctuated by long periods of doing nothing or stagnating, and then another step up. But it's these step-ups that are so significant in nature to your P&L, that's what's adding this edge. And this is where you need to be patient, because I don't think people have the level of patience needed to get the full benefits out of a trend following strategy. They're demanding this instantaneous return, and that's not what the market delivers. We are dependent on what the market delivers. And you can never predict that in advance. So you just know that with this asymmetrical design strategy, which is open-ended with its profit potential, when these periods occur where the markets suddenly have these major transitions, you get these magnificent uplifts. Look, we're getting a stunning uplift now in our equity with this long move here. Now, we would have never predicted this extent of move. This is quite clearly, a lot of people here would have been saying, oh, this trend's got to end. So they'll be going counter trend. They'll be going counter trend. But what we're doing is simply following price. We have no verdict on where price is going to go. We follow price with a systematic strategy, and we're hands off. We're just watching this stuff.
The other thing to remember here is we're looking at one instrument. So we're getting these large step-ups at various points in time. But if you then add that equity curve to all the other equity curves in our total portfolio, and we're looking for steps from each of those, if the steps are offsetting each other, it does smooth out the equity curve. Now, we haven't been able to show that yet, but once in the future podcast, we'll combine all these equity curves and show you the outcome of that.
Yeah, exactly. So that was a great result on USD JPY. I'll just blow up this equity curve a bit. So it's not this gradual line going up. That's a sort of myth in our trend following world. That doesn't exist. So if you wanted a nice linear line at the individual market level with a trend following strategy, what that says is you are demanding the market delivers a trend at all instances in time. We know that doesn't occur. So we've got to recognise that the profile of our return streams, we never at the individual market level get a nice linear return stream. That is only achieved at the global portfolio level when we start consolidating all of these individual equity curves of the different markets together. And as Fred said, the timing offsets of the outliers and the drawdowns, because they are uncorrelated in nature, offset each other. And that's when you see at the portfolio level that you do start getting this linear line, but you still get these very strong step-up periods, for instance, in 2008, in 2014, in 2012, where the markets all of a sudden become fairly highly correlated during these very volatile sessions of transition, where a lot of the markets tend to be transitioning together. And during those coordinated periods, because we are diversified across a broad range of markets, you'll find that we do get sometimes these amazing positively correlated step-ups, which are significant in nature.
Okay, now, Rich, sorry, Darren, I was just going to say, Rich, you're starting to tease us now. We want to see Bitcoin, but I'll let Darren ask his question.
Yeah, I just wanted to be clear. That was just 5 different versions of a Donchian breakout strategy running at the same time. So different trail settings, but essentially just 5 different versions of a Donchian breakout, yeah?
Correct.
Yes.
Awesome.
And here's the result. So our profit factor for this from 1983 to current day, which is about almost 40 years, 2.43 profit factor. We have total trades of 431. Now, these number of trades obviously are far lower with this 5 solution offering we're doing now, as opposed to the 20 solution offering, but are still quite a nice sample size for this particular individual market. And you can see our short positions one here was only 14%. Long positions one were 63%. Once again, that is indicative of the fact that we have positive swap on the long trade. If we look at the instrument details here, you'll see this long swap of $4.55 per lot. That means that in addition to the benefit of these trends, we are getting a positive carry on these trades because we're getting a preferential interest rate paid to us by holding them for a long period. In the short direction, it's a negative $11.63 swap per lot. So this is where Fred's adjusted trail is used to adjust the trail behind each trade to offset the costs of that hold with the negative swap in place. So that's why we get this variation between our short positions 1 and our long positions 1.
The other thing you need to be aware of, or the members need to be aware of, is that the swap figures that we're using are today's swap figures. We don't know what the historical swap was, but the EA, if it was run in real time in the past, would have accounted for that. But right now, we're basing this test on our current swap numbers.
Yes, and look, the swaps do vary, but look, I am trading strategies for the last few years, which are positive carry strategies, and the swap has not flipped from positive to negative over the course of a 2-year period. So where we get a long swap that is relatively high and a short swap that's relatively high, over the course of time, you won't find that they're regularly flipping into different areas of swap from negative to positive. They'll tend to stay on one side or the other. Where the problems lie with those instruments where the swap is very close to zero, which means that when there's an interest rate differential or a change in interest rates between the particular pairs we're trading, the currencies, you might find that the swap does flip. But what Fred and I do there is when that trade ends, we therefore flip the technique to an adjusted trail technique. So in going forward, we actually won't be trading just positive swap. We'll be trading the adjusted trail technique, which is therefore beneficial to positive swap or adjusted trail for all of our solutions. So Fred, you might want to talk more about that.
Yeah, it might confuse people now to bring that up, but we can talk about that in the future. But the reality is, if it's costing us to stay in a trade, we're adjusting our trail to account for that cost. If we're taking benefit from that trade, we're happy to let it run longer.
Yeah, and for me personally, the fact that Rich was able to work out that was significant and that you were able to code it into an EA is pretty impressive.
Show me Bitcoin. I want to see Bitcoin.
No,
yeah, Bitcoin.
No, so we're going to do AUD USD. Just to convince you, this is another very long-term test, and then we'll go to Bitcoin. So here we go. Here's AUD USD. How does this one go? Let's speed this up very fast. So unfortunately, the equity curve won't be able to keep up because this is now going through very fast. But at least visually, you'll be able to see what's happening. You can certainly see that the equity curve is lifting. It's a bit delayed though. So a move such as this with the shorts is kind of, oh, here we go. We can start seeing the impact on the floating equity now. Now we have the longs. So it doesn't really matter what instrument we're putting this on, guys. This particular technique is pretty stable.
Yeah, I know. It's this is the bit that really blows me away. It's, I mean, how many times I've been through, trying to automate systems, and then you always kind of fall down on other instruments, and you get the complete reverse effect. And here it's just so consistent. Whatever instrument you throw it at, it's really.
I think Fred and I are definitely blown away as well, mate.
No, we predicted this, didn't we?
Once again, 2.11 profit factor. The relative drawdown here was 38% on a $100,000 account. Now, remember, 38% seems a lot, but when we compile this with, say, 30 other different markets, our portfolio is going to have a far lower drawdown than what we're achieving on any individual instrument. But we can talk about that now, but we'll see it later when we practically demonstrate what happens at the portfolio level down the track when Fred and I have finalised this process. So, all right, you've all been waiting. Let's go to Bitcoin. All right, so now in our prior podcast, Darren and I were talking about Bitcoin, and he was teasing me saying we really should be looking at Bitcoin. Trend following should work on Bitcoin, shouldn't it? And I was saying, well, we need data, and fortunately we do have. We've got about 10 years of data here, so that's enough. And let's see how this particular strategy copes with Bitcoin. We're going to go on a pogo stick ride here, so let's set her up.
Suspense is killing me.
So now we have to add 4 years to our earliest data. Our earliest data is from 1st of the 7th, 2010 for Bitcoin. We've got to add 4 years to ensure that all of our indicators are firing from the outset the strategy starts. So the earliest we can start from is 16th of the 7th, 2014. So I'm just going to put that in, 16th of the 7th, 2014. Now the spread on Bitcoin is huge. Let's go to it. The spread on Bitcoin at the moment, it's about 1,000 points. So we double our spread. So here we go. We're going to apply a hefty 2,000 points here. And
just slow it down a little bit, Rich.
I'll slow it down. All right. Are we ready? Engine starting. Here we go. So we're starting at this point here. Straight into a short. Now, we've obviously missed this magnificent volatile spike here, but we've got to start somewhere. So we started here. I think we can just go fairly silent here and just look in awe to see what this thing produces. At the moment, it's not too exciting. It's a bit depressing. Our floating equity is slowly declining on us. But now we've got a long trade here. Oh, there's a nice spike. Let's see how long this goes. Oh dear. It's a wicked instrument. Wouldn't this would make your days, wouldn't it? This is just made. This is where we'd be buying a few yachts and coming over to visit you, Darren, in the UK. Up to 2018. Our equity took such a large lift. So from $100,000, we're up to 1.4 million in equity.
That's insane, isn't it? And the way it deals with the whipsaws as well, by giving so much room. I mean, you might lose one or two trades with a whipsaw, but it just holds in there, doesn't it?
It does. So let's go to our stats. Let's have a look at. Are you ready? Profit factor. 63.57. You wouldn't believe it. 63.57. Total net profit. How many figures are here? 11 million. Starting from $100,000 start. Long positions won 34%. Short positions won 14%. Largest profit trade 371,000.
I'll have one of those things.
Lost trade minus 3876. I think we've got positive skew here. So
all we needed to do was be invested in Bitcoin at the beginning, and we'd be laughing.
Yes, which is a nice hindsight statement. But look, I suppose what it does show you is that this particular nature of strategy, it is unbounded in potential. Because we do not have a profit target, we do not cap the upside opportunity. So if there is such a market that exists that we jump onto, which behaves like this, I think we'll be very happy.
What is also interesting is that the big trade that we took there didn't close out anywhere near the top. It was like a 50% retracement from the peak almost, and still delivered a healthy profit.
Yes. Yeah, one solution went up here, another solution was up here, another solution up here, short solutions. Yeah. So
I'm speechless. I've got nothing to add.
Apart from, let's start Bitcoin.
Yeah, well, I mean, this is what we thought should happen when you look at the price moves from this market. So it's validation really for the strategy doing what we thought it would do.
Yes. Yeah, exactly. So yeah, look, I think that's probably it for this particular session, guys. Look, what I thought I might do is show you what we do in the back end of MetaTrader. We've been showing you these reports which are directly derived from MetaTrader, but I might just show you some of the files that we generate, which we use for our portfolio compilation process and what Fred uses for a lot of his programming. So where you find this information is when these runs are undertaken, we write this information to a CSV file, and you'll find that in the, if you go to Open Data folder, you'll find this in the tester module, and you'll find this section called Files. When you come into Files, you'll see we have three broad forms of file for this particular test, which is a performance file, a portfolio equity file. What that does is it looks at a time series to look at what our equity was, and a trade history file. I'll go into each individual one. But for instance, in this podcast tonight, we've shown you AUD USD, we've shown you USD JPY, and we've shown you Bitcoin. So you can see how these files have been saved. This is the performance file, so we'll go into AUD USD. Now, the reason why we create these files is that MetaTrader as a backtesting solution is fairly limited and rudimentary. We need additional information for our purposes of testing, which is above and beyond what MetaTrader produces. So with this particular performance file, this is simply the performance of the run itself, looking at the open date, the close date, the period, which is the daily time frame, the total net profit of the run, the number of trades, and the dollar risk per trade, which is $500. We volatility adjust our trades based on the ATR technique. The compound annual growth rate, the maximum drawdown in dollars, the maximum drawdown in percent, and the MAR ratio. These are critical metrics we use for our portfolio compilation. We also get information regarding the total swap in dollar terms, the spread in dollar terms. So we like to be able to break down the total costs associated with the trade, such as the spread, the swap, any commissions charged, to determine our total costs. You won't find that in MetaTrader. We need to segment that out. We don't have any slippage assumptions embedded in this particular test. However, when we undertake our testing, we always double the current spread, which gives a bit of leeway to include some slippage assumptions in there. So that gives us an idea of our total cost structure. Also, the probability of the win, the average loss, and this is a very important metric for us, a skew. We like to be only trading positive skew. We've had many podcasts before, but negative skew strategies do what we refer to as warehouse risk. They're a bit deceptive in that you think you've got a very robust, stable strategy on your hands, but that's simply because it's trading a favourable market condition. When you look at the application of that particular convergence strategy over unfavourable market conditions, it fails. It not only fails a little, it fails a lot, and you often have risk of ruin. That's because of this warehoused risk that lies in the embedded assumption that that nice linear equity curve you get from your mean reversion is the total story. It's not. The total story is you've got to test it over a broad range of different market conditions, which quickly shows how fickle and short-term those nice linear runs are. This is a performance file. We'll go into the portfolio equity files. So let's look at Bitcoin in this example. So what we have here is the complete time series done on a weekly basis. So our complete run is done on a weekly basis. Each week we record the equity, the realized balance, the floating balance, which is represented by this column here, and the particular series. This series relates to effectively like a magic number applied to this particular strategy, applied to this particular market. Fred, anything you want to talk about in this?
Only that you can see there the 5 series making up the 5 different EAs that we've got combined into that particular run.
You go there. Yep. Let's quickly go into the trade history files. So let's go to USD JPY here. So this gives us a complete trade history for each of the trades undertaken with the test. It includes all of our costs, such as our spread, our commission, any swap costs. It looks at things from both a gross profit factor and a net profit factor. The particular strategy number detailed here. It also includes what spread was applied for the test, the spread in dollar terms, the longs, the swap long rate, and the swap short rate, whether it was a buy, sell, etc. This is our trade history file, which is used for some of our calculation purposes for our portfolio management, but that just gives you a background of some of these extra files we generate to give us additional information we need for our portfolio construction purpose.
Richard, jump past the...
Oh, yes, good point. I'll go back. Sorry about that. The metrics file. Sorry, the parameter files.
Parameter settings, yeah.
When we go into these equity files here, we'll see these additional files generated, which are called parameter sets. Let's go into AUD USD. So as we go into AUD USD, you'll see that each of our 5 strategies is labelled here, and we keep a record of all of the particular settings applied to each strategy. So for this AUD USD version, we were using a 50-period Donchian, a 250-period Donchian, a 350-period Donchian, a 400-period Donchian, and a 500-period Donchian. The initial stop ranges from a 2 ATR initial stop up to a 5 ATR initial stop. Our trailing stop in ATR multiples ranges from 7 up to 13. The adjustment here relates to our method of weighting these individual strategies so that each of them have the same relative drawdown. We do that because we don't want any particular strategy combination to have any undue influence on the portfolio, and we want a similar influence of each of our parameter sets in our strategies on our overall portfolio. So this adjustment figure scales up or scales down our position size to come up to a standard comparable relative drawdown for each one of these strategies. Fred, do you want to say anything here?
Yeah, you're seeing 5 strategies there, but they're the outcome of 20 million iterations of strategies where we started with something of the order of 20,000 possible combinations, and these are the ones that are filtered out and came to the top of the pile. And they came to the top on the basis of how these 5 combined together to give us the optimum that we could find out of our 20 million iterations, the optimum configuration. So the best risk-adjusted return.
Yeah. There are a couple of other indicators we do use, but they're more for the we don't vary the variables for these particular indicators. So this EMA relates to I think it's actually a simple moving average we apply here. We've titled it EMA, but that's a moving average we apply, a 10-period moving average apply to ensure that in conjunction with our Donchian break, we need a 10-period momentum signal in our side to reduce the number of possible false breakouts we might get based on lack of underlying momentum, pushing that price through that Donchian. So the key variables here is our trail type here relates to a particular type of trail. We're using a stepped trail for all of our techniques here, as opposed to a continuous trail. The step trail means that we lag our price using a step trail technique of a certain ATR width, and so when price moves more in our favourable direction, we periodically get this step movement in our trailing price behind it, as opposed to a continuous trail which would be updated every bar. This step trail only occurs at periodic periods of time. Fred, do you want to talk about that at all?
Well, we have covered that previously in a number of other videos, but you can also see it when you were running your back test, where the trailing stop was jumping from position to position. It wasn't just progressively moving down; it was actually stepping down as it went along.
Yep. As we enter here, our trail, our initial stop might be here. Our trail might activate at this point here, and then we might get a period of a step and another step and another step, as opposed to a continuous trail following price.
Can I just jump in there, guys? Any reason for having a step trail and not a continual one?
No reason, mate. It's one or the other, as far as we're concerned.
Okay.
We did, just to clarify that, we did quite a number of tests, again, iterating between both step and continuous. And the reality is that having that option in there doubles the number of possible scenarios. And over time, we couldn't really see a distinction between the two. So we've just settled on the step. But we could just as easily trial it on the continuous also. But the step seemed to give the trend just a little bit more breathing room, and we found it a bit more effective over the longer term.
Yeah. Yep. Which is what you'd imagine in markets that are quite noisy.
Yes, mate. Yeah. So anything else, guys, or should we wrap this one up now?
We could just run through Bitcoin again. I enjoyed that.
Oh, we'll leave that for memories, mate.
Yeah, brilliant work, guys. I'll speak to you next week.
Okay. Catch you soon. Cheers, buddy.
Bye.